When I sat in those bucket shops as a young man, the thing that struck me wasn't just the price going up or down. It was the tempo, the feel of the tape. Most people stare at a chart and think the signal is in the level. But the truth, at least the truth I traded with, is that the real clue sits in the persistence of the move. Ever notice how a market that's ready to reward you tends to give you time, but not too much time, and a market that's finished with you slams the door the moment you start getting comfortable? Ask yourself, how often have you mistaken noise for opportunity simply because the window looked open? But you never checked how long it could reasonably stay that way? That's the hidden clue most traders don't even think to look for. They count points, not minutes. They watch candles, not momentum decay. See, a real profit window behaves like an open invitation, but the invitation has an expiration date. The market just doesn't stamp it for you. You have to feel it out. You have to watch how price behaves right after it breaks out. Does it follow through cleanly, or does it hesitate? That hesitation is the tell. And tell me, how many times have you ignored that little delay, that tiny pause that whispers, "Careful, this door may close faster than it opened"? I learned the hard way that a market's strength is never proven by the breakout itself. It's proven by the speed of the follow-through. When a trend is healthy, it doesn't stumble out of the gate. It moves like it knows exactly where it's going. But when a breakout creeps, stops, stutters, that's the clue. The window is already shrinking. You can almost feel the hinges tightening. And if you push your luck in that environment, you're not trading anymore. You're hoping. Have you ever caught yourself doing that? Sitting there, telling yourself the market to move because you want it to. That word, ought, has probably emptied more accounts than bad entries ever did. You have to understand the market always broadcasts how long the profit window is likely to stay open. Not perfectly, not predictably, but enough for the trader who's paying attention instead of daydreaming about profits. When the momentum is clean and the dips are shallow, the window stays open longer. When the momentum is choppy or the pullbacks deepen too early, the window narrows faster. It's like watching a runner. A strong runner doesn't slow down right after crossing the starting line. So why expect a sluggish breakout to carry you to glory? Think about your last winning trade. What made it work? I'll bet it wasn't magic. I'll bet it wasn't luck either. You probably entered at the right moment, and the market did its part by moving smoothly for a while. That's the profit window. It wasn't about the indicator you used. It wasn't the fancy setup. It was the simple fact that the move had life in it. You caught something that had room to run. And that's what most traders forget to measure. Does this thing actually have the stamina to reward me? Or am I forcing a tired market to work overtime? And let me tell you something that might sting a little if you find yourself babysitting a trade, watching it tick against you, praying for it to turn around. That window didn't close on you. It was never open in the first place. You only imagined the opening because you wanted one. Ever done that? Pretended the market was giving you a chance when it was really warning you away. What separates the seasoned trader from the gambler is the ability to judge whether a move is unfolding naturally or artificially. A natural move behaves like water downhill. Effortless, direct, continuous. An artificial move wobbles. It tests your patience. It gives you reasons to doubt it 5 times before moving once. In my day, I'd see these artificial moves and immediately know the profit window was going to slam shut faster than most men could blink. And yet traders would cling to them like driftwood. Why? Because they didn't understand that the duration of opportunity matters just as much as the signal itself. Let me ask you another question. Do you size your positions based on the likelihood of follow-through, or do you size just because you like the setup? A setup is nothing without follow-through, and follow-through is nothing without time. If the move runs out of breath too soon, you're stuck holding dead weight. Good traders don't hold dead weight. They let it go before it pulls them under. The key is to observe how price behaves immediately after your entry. Not 5 minutes later. Not after you've made a cup of coffee. Right then. A strong trade will show its character almost at once. You'll see the market lean into your direction. You'll see volume behave like it's on your side. You'll see dips get bought, not abandoned. Those are signs the profit window is open, and you can operate with confidence. Not recklessness, but confidence. Without that, you're just guessing. I always said that money is made by sitting, not trading, but that's only half of the truth. You sit when the window is open. You don't sit when the air is gone. A lot of traders confuse patience with stubbornness. Patience is staying in a good trade because you identified a window with room to extend. Stubbornness is staying in a bad trade because you refuse to admit the window was never open. Which one are you practicing more often? And here's something else worth noticing. The market rarely offers long windows during periods of uncertainty. When the tone shifts, when the tape turns muddy, when the big operators stop showing their hand clearly, those windows shrink dramatically. That's when you shorten your leash. You don't stop trading entirely, but you trade in smaller bites because the opportunities evaporate faster. Ever tested a breakout during a choppy week? How long did that window stay open for you? A trader must think like a hunter. The clue isn't just in spotting the prey, it's in knowing how long the shot will be available. The market gives you that information in price behavior, in rhythm, in the intensity of the move. But most traders get so obsessed with being right that they forget to watch the clock that isn't on the chart. And as you start paying attention to this hidden clue that most folks never see, you'll begin to notice something else about yourself. You'll notice whether your mindset is aligned with opportunity or with impatience. A trader with the right mindset doesn't chase windows that are closing. He waits for one that opens naturally. He respects the tempo. He respects the pace. Because he knows that trading isn't about grabbing every move. It's about recognizing which moves actually have the. When traders talk about breakouts, they usually treat the breakout itself as the whole story. They see price push past a level and think, there it is. That's the signal. But the real clue, the one seasoned operators quietly rely on, comes after the breakout. It's in the momentum that follows. The strength, speed, and consistency of that next stretch of movement tell you far more about how long the profit window is likely to stay open than any trend line, indicator, or textbook setup ever will. And if you've ever wondered why one breakout gives you room to operate while another suffocates you almost immediately, that difference lives in the character of the momentum that comes right after the level is crossed. Momentum after a breakout is like a lie detector test for price action. A breakout that's ready to sustain a move behaves with energy. It moves with purpose. You'll see price push beyond the level not just by a tick or two, but with a kind of urgency that shows real demand or real supply stepping in. There's a conviction to the move, and if you watch closely enough, you'll see that conviction translate into smoother candles, firmer closes, and faster follow through. It's the tape telling you the market has the strength to carry traders along for a while. Have you ever noticed that the cleanest breakouts almost feel easy in the first few steps? But on the other side of that coin is the breakout that barely crawls. It pokes above the level, hesitates, pulls back, retests, dithers. It's technically a breakout, yes, but the momentum is anemic. It's like a runner stumbling right off the starting line. And that's your early warning that the profit window may be razor thin. If the market can't push with clarity right after breaking past a point of interest, that means buyers or sellers aren't fully committed. When commitment is weak, the move shrinks. The opportunity shrinks with it. And often, traders who jump into slow, heavy breakouts find themselves stuck long after the window has already closed. Ever been caught in one of those trades that looks promising at first glance, but feels wrong the moment you're in? The speed of the follow through is a hidden clock. When momentum expands right away, you typically have more time to manage the trade, scale in, hold through minor dips, or let the trend carry you. A strong move tends to reinforce itself, attracting more participants, which extends the window naturally. On the other hand, when the immediate momentum is sluggish, every small move against your position feels exaggerated. Volatility becomes unpredictable, and the market starts acting choppy instead of directional. In that environment, windows don't stay open. They flash, flicker, and vanish. That's why momentum right after entry is often more important than the setup that got you into the trade. Momentum also reveals which side of the market is actually in control. A breakout with strong thrust shows that the dominant side is taking charge. It tells you that smart money is supporting the move, and smart money rarely commits halfway. They push with intention. That intention buys you time in the trade. Weak momentum, however, signals a lack of conviction. It means the market isn't unified. Some participants may agree with the direction, but not enough to sustain it. And you, as a trader, need sustained movement to extract profit. A half-hearted breakout is a warning that the market is undecided, and an undecided market rarely offers generous windows. Another important clue comes from observing how quickly early dips get bought or early pops get sold. In a strong continuation, the market doesn't allow deep pullbacks right after the breakout. Dips are snatched up quickly, proof that traders are eager to participate. That eagerness stabilizes the move and expands the opportunity window. If dips linger, if price meanders too long, if buyers or sellers aren't assertive, the profit window shrinks. The market is essentially telling you, this move doesn't have much fuel. A momentum also ties directly into your own mindset and decision making. When momentum is clean, you feel less internal conflict. The market is doing the work. You're reacting, not forcing. That reduces stress and helps you hold winning trades longer. But when momentum is sluggish, uncertainty creeps in almost immediately. You begin questioning the trade, doubting the setup, second-guessing your plan. Even if the trade eventually moves, the short window of clarity makes it harder to manage. And the harder a trade is to manage, the more likely the window is either short or unreliable. A lot of traders misunderstand momentum. They think it means fast, explosive moves only. But momentum isn't about speed alone. It's about consistency. It's about whether the market is behaving in a way that suggests continuity. A slow move can still have strong momentum if it's orderly, decisive, and unopposed. Conversely, a fast move can have weak momentum if it's erratic or unstable. The kind of momentum that predicts a long profit window is momentum that shows stability and intention, not just velocity. The key is training yourself to observe this right after the breakout event. Don't wait 10 bars later. Don't excuse early weakness. Don't rationalize a slow start as just a retest. Watch those first moments with the seriousness of a detective examining the first clue at a crime scene. The early follow-through reveals the truth. It tells you whether the market wants to move, or whether it just briefly poked its head above a level before losing interest. And if you learn to read that correctly, you'll start knowing not just when to enter, but how long the window may stay open for you to work the trade. When a breakout first occurs, most traders jump in with excitement, thinking the hard part is over. But the market doesn't reward excitement. It rewards observation. And one of the most important observations you can make is whether the price hesitates in those early moments. That hesitation is not just noise. It's not just a pullback or normal retesting, as many traders like to tell themselves. It's a warning, quiet, subtle, and easy to dismiss, that the opportunity may not last long. If the market pauses too soon, if it struggles to move in the direction of the breakout right away, that hesitation is the clue that the profit window might already be closing. Have you ever watched a trade drag its feet right after you entered and felt that uneasy tug in your gut telling you something isn't right? Most traders ignore that feeling. They convince themselves the market will get going any minute now. They sit and wait for a push that never comes, only to watch price drift back into the range. But hesitation is a message. It's the tape whispering, not shouting, and only traders who've learned to listen catch it early enough to avoid trouble. Hesitation after a breakout means the market isn't ready to commit. It means there isn't enough momentum behind the move to sustain it. And without momentum, even a technically perfect breakout is likely to be short-lived. This early hesitation often shows up as a shallow stall. Price moves above the level but immediately freezes. It might tick forward, then backward, unsure of itself. That uncertainty is not the behavior of a strong move. Strong moves carry forward with ease. Weak moves wobble. And the moment you see wobbling right after the breakout, the market is hinting that the window you're hoping for will probably not stay open long enough to capture meaningful profit. How many times have you seen a breakout hesitate just long enough to lure you into holding, only for it to reverse completely? Hesitation also signals a lack of conviction among the players who matter. When large traders are genuinely pushing a move, price behaves with intent. It doesn't drift, it doesn't shuffle, it advances. But when the push is half-hearted or speculative, that conviction disappears and price starts acting uncertain. That early uncertainty means those big players aren't fully stepping in. And if they're not stepping in, the window for opportunity shrinks because the market lacks the fuel for extension. Without fuel, no move can travel far, no matter how clean the breakout looked on your chart. The timing of hesitation is what really matters. Hesitation 10 bars later may be natural consolidation, but hesitation immediately after the breakout is a completely different signal. It tells you the market reached beyond the boundary, but didn't find the support it needed to continue. That's like a climber grabbing the edge of a ledge and finding nothing solid to hold on to. When the breakout can't grab onto anything, it stalls, and a stalled breakout rarely offers a long-lasting profit window. Have you ever entered a trade that looked strong on the breakout candle, but instantly felt heavy and sluggish as soon as you were in? Some traders try to rationalize hesitation by calling it a test or shakeout, and sometimes it is, but far more often, it's simply the market telling you that strength is lacking. You cannot rely on hope in those moments. The market doesn't reward hope. It rewards accuracy in reading behavior. If hesitation shows up right away, you should assume the opportunity will be shorter, riskier, and less reliable. That doesn't mean you must abandon the trade, but it means you must treat it differently. Smaller size, quicker profit, taking tighter stops, the profit window won't tolerate anything else. Another clue hidden in hesitation is the way volume behaves. Strong moves tend to accelerate with supportive volume. Weak moves often break out on lower volume, then hit a wall the moment price tries to continue. That wall is hesitation turning into exhaustion, when the market can't attract interest right after breaking a level. That tells you the window is small. It may open, but only for a moment. And if you miss that moment, or try to stretch it, you're left holding a trade that no longer has participation behind it. Hesitation also affects your mindset in ways most traders don't acknowledge. When you enter a trade and see immediate follow-through, confidence rises. You're calm, focused, and willing to let the move develop. But when hesitation appears instead, your mindset becomes reactive. You start questioning your timing, worrying about reversals, staring too closely at each tick. That mental tension is not just emotional, it's a clue that your read on the opportunity window is changing. Your instincts are sensing that something about the move doesn't match the conviction you expected. The hesitation you see in the chart becomes hesitation within yourself, and the longer the market hesitates, the shorter your window becomes. What separates skilled traders from those constantly stuck in marginal trades is the ability to see hesitation not as noise, but as information. You don't need complicated indicators or expensive tools to catch it. You just need to pay attention. Watch how price behaves in the first few moments after a breakout. Watch how quickly, or slowly, the market tries to continue. Watch whether it pulls back immediately or drives upward with strength. Those tiny behaviors are the market's way of telling you how long the opportunity is likely to last. If you start recognizing hesitation early, you'll stop overstaying your welcome in trades that were never ready to move. You'll stop forcing opportunities that weren't truly open, and you'll begin aligning your trades with moves that actually have the energy to carry you forward. When a breakout begins, the first thing most traders look at is the price pushing past the level. They see that candles stretch beyond resistance or slip under support, and they feel a surge of optimism. But the real signal isn't the breakout itself. It's what happens in the moments right after. That's where the truth hides. And if you're watching closely, you'll notice something that separates winning trades from the ones that barely get off the ground: hesitation. When price hesitates right after a breakout, even for just a few seconds or a couple of bars, that pause is the market flashing a quiet warning. It's the chart telling you the opportunity may not last long. Ever seen a breakout trigger your entry, only to start wobbling immediately and make you wonder if you stepped in too soon? That early hesitation is often the difference between a trade with room to run and a trade that fizzles out before you can act. Most traders ignore it because it feels small. They tell themselves it's normal fluctuation. They assume the hesitation will resolve and the move will continue. But the market doesn't hesitate by accident. Price hesitation is a sign of uncertainty. It means buyers or sellers pushed through the level, but not enough of them stayed committed to drive the move forward. And when commitment is thin, the profit window becomes extremely short. You can spot hesitation in many forms. Sometimes it shows up as a sudden slowdown. Sometimes as a thin, wavering candle. Sometimes the breakout bar closes strongly, but the next bar barely moves. Other times price pulls back instantly, almost as if the breakout was just a quick stretch rather than a real attempt to reverse the balance of power. Whatever form it takes, hesitation after a breakout is the market saying, "Be careful, this move might not have enough energy." How many times have you watched a weak breakout stall so quickly that you barely had time to manage your position? Strong moves don't hesitate in the beginning. They hit a level and keep pushing with clarity. When real momentum is present, price behaves like it has a purpose: clean structure, smooth flow, and follow through. A market that breaks out with intention doesn't doubt itself right away. That hesitation is telling because it signals a lack of collective conviction. If the big players, or even the steady medium-sized players, aren't pushing the move, the window of opportunity shrinks. A market without commitment is like a match that sparks but doesn't catch fire. Inexperienced traders often confuse hesitation with a healthy retest. And yes, real retests happen. But a healthy retest has structure, timing, and rhythm. It shows the market gathering strength, not losing it. Early hesitation, on the other hand, isn't strength building. It's hesitation born from indecision. The market hasn't gathered enough pressure to sustain direction. And if the market isn't ready, your trade isn't ready. Ever held onto a breakout trade, hoping for follow-through, only to watch it sink right back into the old range? Another reason hesitation matters is because it disrupts the psychology of your trade. When you enter a position and the market immediately moves your way, your mind settles. You feel aligned with the flow. You can focus on managing the trade rather than worrying about survival. But when hesitation appears right away, your mindset shifts. Doubt creeps in. You start tightening stops, or watching every tick, or losing patience. That mental shift is meaningful. It signals that the behavior of the price isn't matching the expectation you entered with. And when your expectations and the tape are out of sync, the window for profit is almost always shorter than you hoped. Early hesitation also affects liquidity. When a breakout doesn't follow through, fewer participants join in. Traders wait. They watch. They hesitate because the market hesitates. That slows the move even more, which creates a feedback loop. You end up with a breakout lacking volume, lacking momentum, and lacking participation. A move like that can collapse quickly. And even if it doesn't collapse, it rarely gives the clean, extended window that traders dream of capturing. Consider this: strong breakouts behave like water flowing downhill, effortless, smooth, continuous. Weak breakouts behave like someone trying to push a heavy cart uphill, slow, uneven, constantly losing ground. When the market hesitates early, it's the second scenario. Slow movement, no follow-through, no strength. And if you're honest with yourself, how long do those trades ever stay profitable? Hesitation also exposes the intentions of the market makers and larger operators. They cannot hide conviction, and they cannot hide the lack of it either. When they are committed, the breakout continues naturally. When they're uncertain, the breakout stalls. Watching hesitation is a way to see their footprints without any special tools. They reveal themselves in the rhythm of the follow-through. Most traders react too slowly to hesitation because they don't trust their read of the tape. They wait for confirmation that rarely comes, or they try to rationalize the hesitation away. But by the time they realize the move has no real strength, the window has already narrowed to almost nothing. The beauty of watching hesitation is that it costs nothing and requires no indicators. It's pure observation. And the earlier you recognize hesitation after a breakout, the better you can judge whether that profit window is wide open, barely cracked, or already sliding shut. When you watch a trend in motion, one of the most reliable clues about how long the profit window will stay open is in the behavior of the pullbacks. Strong trends don't just move forward, they glide. They breathe in a steady rhythm. The pullbacks are shallow, controlled, and short-lived. That's the kind of structure that tells you the move has stamina. When you see shallow dips, the market is saying it's not interested in giving much ground. It's showing confidence, and confidence in price action almost always translates into a longer, lasting opportunity for a trader who knows how to listen. Have you ever noticed how the best trades barely make you sweat in the beginning? Think about those times when you caught a real trend, one that felt smooth right from the entry. The dips didn't drag on. They didn't force you to question your timing. Instead, price would pull back just enough to shake off the impatient crowd, then snap right back in the direction of the trend. That's the signature of a strong move. It's not just the upward or downward motion that matters, it's the unwillingness of the market to retreat deeply. When you see shallow pullbacks, you're not just seeing price behavior, you're seeing real conviction behind the move. Shallow pullbacks happen because there's demand waiting beneath every small dip in a bullish trend, or supply waiting above every small bounce in a bearish one. That means more people want to participate. More people want in. And when more traders want in, the window for profit stays open longer because the trend maintains its pressure. It doesn't need dramatic surges, it just needs steady, persistent interest. Ever seen a chart where every tiny pullback lasted 1 or 2 bars, and then the trend marched on? Those are the markets that give traders room to operate without constantly threatening to knock them out. A shallow pullback is a sign that traders aren't panicking. They're confident enough to hold. They're not scrambling to exit at the first hint of weakness. When the crowd is calm and willing to buy dips, or sell rallies in a downtrend, the market stays orderly. And an orderly market is ideal for riding a trend. Deep erratic corrections, on the other hand, show uncertainty. That kind of uncertainty shortens the window because the market doesn't have the collective conviction to maintain direction for long. What makes shallow pullbacks such a powerful clue is that they expose the underlying tension in the market. When a trend is powerful, it doesn't let price fall far because the opposing side doesn't have enough strength to push back. Sellers can't drive price down much in a strong uptrend, and buyers can't lift price much in a strong downtrend. That imbalance is exactly what creates a wider, more reliable opportunity window. The side in control is firmly in control. A trader who learns to recognize this is at a huge advantage. You can stop guessing whether a trend has room to continue and start reading its character bar by bar. If every dip gets bought quickly, that's a trend with life. If each dip starts reaching deeper, staying longer, or attracting too much volatility, that's the trend warning you that the window is tightening. This concept ties directly into your ability to hold a winning trade. One of the hardest parts of trading is staying in a good position long enough to extract meaningful profit. Most traders get shaken out too early because they misread normal pullbacks as signs of reversal. But when the pullbacks are consistently shallow, that's the market giving you permission to sit tight. It's telling you the trend still has strength. And when you learn to trust that behavior, you can hold longer without letting fear push you out. There's a psychological element here too. A shallow pullback builds confidence, not because you're imagining things, but because the tape itself is reassuring you. When the market refuses to give up more than small pieces of ground, you don't feel like you're fighting the current. You feel like you're being carried by it. That kind of trade is easier to manage. It feels natural, logical, balanced. You're not constantly threatened by the idea of reversal. And when your mind is calm, you make better decisions, scaling, trailing stops, letting the trend unfold. Strong trends with shallow pullbacks also attract more traders as they develop. People see the consistency, the reliability, the smoothness of the move, and they join in. That added participation extends the window even further. Trends often last longer than people expect because each shallow pullback invites fresh entries from those who missed the first part of the move. And those fresh entries become fuel. When pullbacks start getting deeper early in a trend, that's the opposite signal. It means the window is small. It means the crowd isn't confident. It means the market is bouncing around because traders don't fully agree on direction. And a market without agreement cannot offer long windows. It can offer quick trades, scalps, maybe small bursts of opportunity, but not the kind of extended run that allows a trader to sit and build profit patiently. So when you watch a trend, don't just look for the breakout, the candle color, or the indicator reading. Watch the pullbacks. Watch how much ground the market gives up. Watch how quickly it reclaims momentum. Those shallow dips are a map.